Hi, this is Randy Finney with Right Side of the Chart, and today is Friday, July 8th, 2022. It's 10:30 a.m. Eastern Time as I'm starting the video, so we're an hour into the trading day. And in this video, we're going to cover the precious metals. So that would be gold, silver, platinum, palladium, as well as the mining stocks we're going to look at. And then finally, at the end of the video, just a quick update on the euro and the U.S. dollar, and to just really, impress upon the correlation there and the impact that they have on gold. So I'm going to start out here where you can see we're on an economic calendar. I just wanted to mention that nothing's changed in my outlook, and today was a great buy the dip opportunity in the morning. The economic calendar is on right side of the chart.com. If you go to the top menu under resources and then tools of the trade, under that subsection you'll see the economic calendar. And so what happened today is we had the employment situation report out at 8:30 a.m. And in that you had non-farm payrolls. That's a big one. Came in at 372, very hot number. The consensus range was 190 to 350. In this bizarre world of a market, it sold off. There was a knee-jerk reaction, well over 1% drop in the futures. Great buying up. I jumped all over that. Okay, so okay, I get it. This is very strong bullish information or bullish data for the economy. It's all about, if you're not familiar, if you're not into economics, the consumer spending accounts for over 2/3 of GDP, gross domestic product, pretty much, if you want to call it the earnings of the United States of America, right? So for the most part, this is a sum of all the products and services sold. And so the consumer, as much as the government can, manipulate and spend print money and stimulate the economy, it's at the end of the day, if the consumer buckles in, tucks in the belt, then the economy will go down because they quit spending, and then things fall. So anyway, so this was a strong number, good for the economy, telling you that we increased jobs by 372,000, well above the consensus range, especially the median, the consensus being 270. Okay, so that's good. Unemployment rates still hold right on consensus. Private payrolls looking for a consensus of 228, 381. So why did the market sell off? Well, that's, I guess, those people that figure, oh no, that just seals the deal in another rate hike. Well, first of all, the Fed's not going to do. We have Fed governors speaking all the time. There was one today, one yesterday. Look, at most, we're going to get what they said, 50 to 75 basis points, and that's pretty much baked in the cake. My guess it'll be closer to the 50. Maybe this gives them room to do the 75, but here's the thing, guys. Okay, why has the stock market been going down, other than the technicals, of course, which was priced in? Well, we've gone over that. That's all I do here. So the consensus is that the stock market's falling because the Federal Reserve is raising interest rates. Okay, so why is the market falling? Well, because it's implied that when interest rates are raised, it curtails and slows economic growth. That's the whole point of the Fed raising rates, to curb or slow the rate of inflation or try to stop it in its tracks. All right. Okay, but what do you have in a perfect world? We can still have right now. This is showing the economy is still growing. We're still adding jobs. Again, that's the single most important indicator of the economy. And yet the Fed's raising rates, and it's actually working. Okay, what am I talking about here? Again, I didn't want to digress too much, but this is kind of it's a single data point, by the way. First of all, let's not read too much into it, but this is a Goldilocks scenario for the Federal Reserve. They're raising rates, and so far, at least by this, remember DJP is one of my go-to commodity ETFs, very well diversified basket of commodities, and boom, this is what's happened. The inflation bubble, at least a big part of it's been pricked with a big drop. And this is just a weekly chart here. I'm going to grab that high. From high to low in a matter of just a month, we had about a 23% drop in this broad-based index of commodities. It has it all in there: gold, oil, natural gas, corn, soybeans. You got ag commodities, just about every commodity, so very well diversified. Okay, so the rate hikes are working, at least at this point. If you want to take that data point, it's certainly slowed down, and that'll be, that wasn't reflected in any of the numbers that have come out yet. I told you this is my real-time indicator of inflation, about as good as it gets right here. You couple this with the housing market data, whatever you can get there, and you've got the bulk of inflation, right, or the lack thereof. And so, kind of like I said, if I look at this one data point, that to me is kind of a Goldilocks scenario. Economy is still growing, but and it's shrugging off the effects of the rate hikes, other than they are doing what the primary intention. Remember, the Fed doesn't raise rates to try to crash the economy. Their main goal is to stop inflation. So, all right, enough on that. Just wanted to say that. So, there's the drop in the futures this morning right there. This is just this is a 60-minute chart. And it also pulled back to support. You have pretty decent support there at 1164. It happens somewhere in here. If I grab it right here, I'm going to move that line. So I'm just going to measure there. That was better than, like I said, it was better than a 1% drop this morning. And they're gobbling it back up, because what happened, the futures dropped pre-market. And then, as I always say, don't take everything with a grain of salt. What happens before the opening bell at 9:30 a.m. The bell rings, and the big boys step onto the field. Those are the institutions. Okay, that's where the big money is. They can maneuver much better in the regular session because there's a lot more liquidity to be had, and you can see a big giant green candle gobbling that up. So just remember, and I'll fire something off if my view changes, and I may be wrong, but I've remain bullish. And when you're in bull mode, in a bullish trend, you buy the dips, right? Sell the rips if you're an active trader. If you want to sell rips into resistance, there's a little previous high. You've bought that pullback today, but again, we're zigzagging higher. So let's get off this. I've done enough on the markets lately. I just wanted to comment to that and say, wow, when I saw that today, I'm like, okay, there's a dip that I'm going to take advantage of. But let's talk about the metals. I fired off a couple posts to you today. We're going to let's just start with the ones I already got out to you today, or the one, palladium. Palladium, this was laid back here a few weeks back in that video, and figured we'd come up to at least here, and we blasted on through that level, and we're still going. So, when you trade something like this, you can target one level, or like I said, you can just trail stops, raise your stops at that point to protect profits, and let it run. This is bullish. This is the 60-minute chart. I'm zoomed in here, but that was a big DL, divergent low right there, and there was your trend line break. It was covered in the video right about here for the breakout back test, and then we were walking up this uptrend line beautifully, and finally just boom, we're really starting to catch a run here. I gave you, or you can trade, if you don't trade futures, of course, there's an ETF for just about everything nowadays, and you have PALL. Nope, that's not it. I wanted to go to this board here and go to PALL, Palladium ETF. And this is what it looks like on a daily chart here. So the metals are starting to run, and it's these two really. These have more of an industrial application, absolutely, than gold and silver. They're primarily, palladium is one of the platinum groups of metals, palladium, rhodium, and platinum, and that's what's running now. And that was just a beautiful bullish falling wedge pattern there and breakout, and we're starting to get some upside momentum there. Positive divergence, everything I like to see. So you also have, closely related is platinum, and there's PPLT if you trade the ETF. There's your divergent low, positive divergence, just like you had right back here, and we're starting to move up. And so like gold, where I'm going, that's why I wanted to lead with these guys. I think gold kind of stretched the limits of what I wanted to see on the pullback, but I'm not throwing in the towel yet. In fact, I'm liking it even more, and that's why I'm doing the video today. Look at this, 1, 2, 3, 4 distinct reactions followed by a big, powerful, and impulsive breakdown. This is how technical analysis works. Again, a blind man can see that support level right there at $84. It's very, very, very apparent on PPLT, which does a good job. It tracks. This is the physical platinum shares ETF. And so there's what happens is traders have their stops there. And they got stopped out, the long side traders, and shorts piled in, thinking platinum was going to the floor or going much lower. And what happened is so far, and it's not over yet, but so far they've reversed it pretty hard. This divergence is yet to be, but could soon be confirmed, meaning a bullish crossover right there to give us a equal or higher low on the PPO. And then if you can move back up, solidly back above $84, then this whole thing becomes a bear trap, aka false breakdown, whipsaw, false sell signal, because all those that piled in short in the weekends that got shaken out will then realize, uh-oh, it was a false breakdown, a whipsaw. The shorts start to get squeezed, have to cover their short positions that are now at a loss. Again, if you recover 84 on a solid basis. And with these divergences, and what I'm about to get to on the dollar and the euro, it could very well happen. So this, by the way, not mere coincidence, this, and I'm going to get to gold in a second, and then ultimately to the euro, US dollar, which I've talked about, which has just broken a major long-term support level. But has the potential to do the same thing here. So this is the gist of this video, and that's why I want to do it in video form. I could not convey all these thoughts into a written post with charts. It's just too much to cover. So this is what we're going to look for. Now, I have to say, breakdown is a breakdown, and resistance, support once broken becomes resistance. So, if you're a bear, you can short, and that may be what happens here. So we don't have the whipsaw yet. We don't have the false breakdown yet. We have to solidly recover that level, and we're going to need to do it, in my opinion, on not just platinum here, not just gold, but also the euro and everything else. So that's what to watch for, how to trade it as you want. There's 60-minute chart, positive divergence. Right now the trend is up, very near term trend. There's your divergent low. I'm just zooming down to a shorter term time frame here, and that would be a back test there. Here on the 60-minute chart, it looks to be about 84, 85. I'd go off this daily right there. There's your levels. And then PALL, I think I already I did just cover that. PALL, type correctly. It's got some resistance certainly overhead right here. Some levels, but that wedge was a nice breakout, and these guys led the way. I think at this point it would make sense to take some profits here if you were in palladium, and maybe roll that into gold and silver. I think they're going to catch, or even the miners. I really like the miners, so I'm going to get to those in just a second here. All right, let's now talk on gold. And let's talk on the weekly chart. And so we did have, which needs to be noted, this divergent high, and it was also at a failure at that previous high, which was also just above the previous bull market all the way back from 2011 when gold topped. So you pretty much have about a triple top there, but we're still in relative close proximity here to the highs. And what happened recently, in recent months really, is we had a symmetrical triangle pattern I was highlighting there. There was your uptrend line. We back tested, started to bounce. I thought gold might be able to rally there. It didn't. Then it took out the trend line recently, and I said this was, and I have to be careful with my words when I say line of sand, but that was really a support level, my final support level for gold, where I'd be comfortable buying down to but not below, and then concerned about stopping out. And I still am. I'll have to be honest at this point. This may not play out what I'm covering here, but what I think will happen is that may prove to be a nice stop clearing move, whipsaw. About the only thing you can count on nowadays in this market is our whipsaw signals, whether it's the nefarious forces that be, the market makers, the algos, I think all of the above. But you almost have to count on whipsaws in your trading nowadays because they happen so often, meaning shaking out longs in the big boys, the institutions, those with enough money to do it. You give me enough money, give me an unlimited bank account, and I can run stops all day long. I know where the levels are, where those stops are, and then I'll bring it down, short something down, clear all the stops out, and then turn around and cover those shorts, buy those shares on the breakdown, and then you get the reversal. And again, those are one of the most powerful things in trading if you do get a false breakdown, because of all those forces I talked about. You shake out, again, what we call weak-handed longs, and then you have just a stronger holding base of people that are still long. If anybody that rode out a break below a well-watched support level, and then only to see the stock or the security get back above, well, why are they going to sell then if they didn't get shaken out there? So that's that logic. And then, of course, you get the short sellers pile in. And short sellers are a flighty lot. I know because I'm one of them. I do both. I love to go long. I love to go short, and but you don't stay short. Short is more of a hit and run kind of thing. Over time, the market and most securities go up in value, so you don't invest in a short position for 3 years. Usually, shorts are my holding periods measured from minutes, days, weeks to no more than months, a few months in most cases. Will I remain long on short? So that's that. So we'll watch that. And again, it's not a hard line. You can see we've traded through it quite a bit. And if you look at it that way, we were here, then a little higher, then a little higher there, a little higher there, a little higher there. We're slightly lower here now, but we're still below all these other reaction lows. So am I crazy about it? No, but I'll like it if we can recover that level. And let's look at, same thing. You're not going to see much more on the daily chart. Silver, SLV, that's what silver looks like. I had this divergent low here. We had a false breakout there. I'm just going to take that divergence line because it's still hanging on by the skin of its teeth. We're still oversold right here on the weekly, but at very, very, very nice support. So to me, you got to like silver here. The trend sucks. It's in a downtrend. Ever since this divergent high has been going down. I can't get a rally going. But as I pointed out here, that was good support. I thought I had a good chance to rally there, and it didn't. It doesn't mean it's never going to rally again. All I can tell you is that this support here, about 1758, is 10 times or several times, let's just say, better than this support. Why? Well, this support was good for about a year and a half with a handful of reactions, whereas this support level goes back major. So it was support here. That support once broken, you had a waterfall type sell-off. You back tested to the button, got rejected again, fell all the way down here. Came up, tried to get it. There was a whipsaw. We did break it, but it couldn't hold. Once they realized it couldn't hold, fell. They back tested once again, rejected. Back tested again, rejected. Back tested again, rejected. So all the way here, tested it again, rejected. Tested it again, boom, that was it. But then finally regained it here, and look at that candle. So, what I'm looking at here is a level that, call it what you want, but this is a very significant level in silver. The trades around it, especially when you get the rejections or the breakdowns, big moves. So on a scale 1 to 10, that's close to a 10 for support. And with positive divergences on the weekly and oversold conditions, oversold, I'll take that trade all day long. And so whereas I liked silver back here, I love it right now. All right, so that's that. Got that out of the way. And GDX now, the gold mining ETF. I always say this, GDX, for the most part, with some exceptions, those exceptions typically being a waterfall type panic sell-off in the stock market. Other than that, when they can get sold down with the stock market, even if gold is going up, because GDX holds gold mining stocks, and just like that word, stocks, that's the key word. They're equities. They're not gold. They're not silver. They're just companies that mine and produce gold and silver. So they can get sold down with the stock market, even if at that point in time gold is catching a bid for a flight to safety or for whatever reason. However, okay, those are very small exceptions. For the most part, gold mining stocks, GDX, is just a leveraged play on gold, meaning if gold goes up X, GDX goes up a factor of X, a multiple of it. It's not a set formula. It's not exactly twice as much, and it depends at different times, but at just about any point in time, and you can just go back in the charts and verify it yourself, look at rallies in gold, and then look how much it went up in percentage terms, and then compare that and see how much GDX went up. So the way I look at it here, you're either going to be right or wrong on gold or silver, and if you want to juice up your returns, even though GDX is not leveraged, doesn't employ any leverage, Again, it's effectively a leverage play on gold. And of course, remember that cuts both ways. So if you're wrong or early, there's a fine line there. My definition of being wrong on a trade is if I buy something and it exceeds my stop and I get stopped out for a loss. Early means I get in and it may go down. Let's just say, I'm loading up here on the way down to this level, but I don't exceed my stop. And it goes down from where I initially bought and then goes on to play out. That's early. So might sound like a little nuance there, but being wrong again is buying something and whether or not for whatever reason getting shaken out, stopped out. So now here's the thing. There's a setup here. There's a major reaction, low major, and I was highlighting GDX. I think it was here. I should have been $29. Very nice support, and that support was taken out. Just like gold's had support taken out. But again, you have the potential here for a big old bear trap. And not only that, so it would be one thing to just say, oh, we broke down, now let's look for a bear trap. That's kind of maybe a wishful thinking, hopeful, if you're, especially if you're already long and underwater the miners, because I did highlight them here recently. But this time around, I can make a strong technical case that may happen. There's a big old bullish falling wedge pattern right there. One of my favorites, and it is confirmed with positive divergence. The indicators are making higher lows right now over those previous lows, and the PPO is starting to curl up. So if we can get some more upside here and up to it soon, we're going to get a bullish crossover here that's going to effectively put in a higher low and confirm that divergence. Right now it's what I call unconfirmed divergence because these are momentum indicators and the momentum is still pointing lower. RSI's turned up. PPO again is starting to curl up, but I like to see that crossover. And boom, we kissed that level 26.15, which was actually support right here. Was resistance, got a pullback. Then once we broke above it, it acted as support, gave us this little descending triangle pattern, which broke out there. Miners were off to the races, but COVID hit and everything fell. Everything got sold with panic selling and liquidation, and including the miners, especially because they are stocks. But then when it was over, they went right back to where they were and continued where they were heading. And then boom, divergent high, divergent low, divergent low, divergent low, divergent low. And each time we had a divergent low, you can see we had a rally. So anyway, that's that. And now to just firm it up. One thing about the miners, there are a lot of different sector ETFs out there, and one example is biotechs. But the biotech sector, when you drill down in the components, they're all biotechnology companies, but they all have different charts. They have different products in their pipeline, different disease states they're going after. Some are big, little tiny biotechs with one single drug in the pipeline that's going to make them or break them if it gets approved or declined, not approved by the FDA. Whereas others have a very broad pipeline, like a Biogen, IDEC, with a lot of drugs in there. So where am I going now? The miners now are very tightly correlated. And I don't think, with very few exceptions, and what I like to do is go through the components of GDX because there's not that many. There's only about 29, I think, companies in there. So it's easy to go through all the charts. And they're all going to pretty much confirm around the same time. So what we're looking at here is, again, on GDX, the mining ETF, and the benefit of an ETF, it's diversification. You don't have to worry about earnings on it because you have a lot of different stocks in there that if one stock craps out on earnings or has something that knocks it down, then hopefully the 28 others in there are going to hold it up at that on that day. But we're going to go through this in order of market cap. So this is a big one in there, the big dog, Newmont, NEM. And I'm just showing you that they all pretty much look the same. Not all, but most. And sometimes I'll go through this, and as I quite often do, I can almost always sniff out the most bullish ones, go long those if it's a half dozen or so, and then ignore the ones with the least bullish or even possibly bearish charts. Again, there's going to be some that buck the trend every now and then, but for the most part, you're going to see similar things, just like you had here. There's your little wedge, divergent low, tested, the divergence continued up to this point right here. See that? We made a slightly lower low, kept that divergence going right there. That's actually what it was. And boom, this thing exploded. And just to give you an idea, that's about a 65% rally that went from the low there in early December up until the April highs right there. And then boom. So this is the nature of these guys. They're very trendy little suckers, kind of like natural gas. It's almost either going up or down at any one time, full throttle. Sometimes there's a little consolidation there, and then from periods of consolidation usually come big moves. So this is a down. Who knows? Maybe we need to consolidate and these don't take off. But if it does, you want to just watch for a break of this trend line, and you can also buy pullbacks to support. This was support here, support, little gap there, resistance. And that's where it just hit $57. This is also support, even better support there, about 59, 53. And you can see we took out that level, but now we've recovered it. So a little more work to be done. Break out this trend line. GOLD, which is Barrick Corp. I wonder how many people buy this. Newbies to investing thinking they're buying physical gold or gold ETF, but it's not. That's Barrick's symbol. I guess they jumped on it early before anyone else did. Anywho, that's there's chart there, and here's the key takeaway. You've got a major reaction low right there back from December, and that's where we're at. So this one is oversold, positive divergence at support, and there's your trend line. FNV, Franco-Nevada Corp, nice clean divergence there, wedge pattern there, downtrend line, strong positive divergence, just like the last time you had positive divergence was right here. If you bought that divergent low anywhere around it, you caught some or all of this 35% rally up into the, you got it, divergent high. Swing, swing, swing. It's pretty, sometimes it's not always so easy, but quite often it is. You just look for these divergent highs, and that's where you start getting out or get ready to get short, swing it down, and then you don't always get divergent lows, but when you do, great. And that's it. And, of course, support right here. So this is where I can see this one, for example, coming down a little if it wants to. If it doesn't break out yet and there's another leg down in the minors so they consolidate for a while, that's about only 6.5% downside. Why did I say only? Well, again, because if it runs up to these other highs, which would be a potential swing target, that's 26%. So if you took it, 6% downside with 24% upside is a 4-to-1 RR. Not a bad risk-reward ratio. AEM at support already. See, here's the thing too with FNV, not yet at support, but I have a lot already at support. And so if these start to rally off support and they go on to break the trend lines, the FNV may never make it down to that support level that's about 6.5% below. WPM. And guys, okay, I'm going to stop here because I can go on all day. You're going to see the same thing. Again, birds of a feather, right? They all have almost identical technical postures. It's not mere coincidence. They all had divergent highs right here, or most of them, and then nice clean trend lines, which broke. And so that's it. So there it is. They have the first, decent setup, whereas I liked them back here recently. I like them even more now. There was a support level. By the way, that would be your first bounce target. Support was about 38.17 right here. But these are trendy little suckers. So if we can catch a bottom here, and then I'm going to just bring this video home with talking about the Euro US dollar. And this will also kind of factor into whether these are just bounce trades here or longer term swing trend trades. So this is what I've been harping on lately. This is a history of the Euro US dollar pair, EUR USD. Goes back for years. And you can see in recent years, and actually through the history of this, you've had multiple pullbacks to this upper or lower line. That's why it's a support zone. It runs from about 105, 234 down to 103, 530. Same chart I got out to you this morning. You hit the bottom of it there. You hit the top several times there. Hit the top there, you hit the bottom recently, bounce, and now boom, this is a first breakdown. So on face value, And until and unless this gets reversed, that is bearish. So it is not an all-in load the boat moment for gold, for GDX, or for the euro, which I threw out as a trade idea today. But it is worth watching because, again, fewer things in trading are more bullish than a failed breakout. So if we can get back up into, and especially back above this level, then this whole thing will be a whipsaw, false breakdown. And that could give us a major trend change in the euro, meaning the euro's rallying against the dollar's falling, and we could target, I would say, at least that long-term downtrend line right there that comes into play. You can see it since really the inception here. And that would be a huge move. And then, go down to the 60-minute chart because that kind of gives us a little more visibility near term. And says that may happen here because you have a nice divergent low, positive divergence here on the 60-minute time frame. It's that similar to that euro setup I gave you on E7. E7's a euro futures. And you also can, if you want to pure play the euro, you can buy FXE. That's just the euro ETN. Similar setup there. There's your divergence, but you're going to be better off looking at the futures. Let me go back to EUR USD. All right, so that's the setup there, and if it can take us back up and then above and into that those recent lows. This is it on a 60-minute chart, but those are those major lows right there. That's the level. We need to take that out. The bearish case would just have us near-term bullish, but longer-term bearish would just have us going up back testing and failing it. But if we can get above, that's going to be pretty bullish, and you can see some other levels there. And again, if you want to trade euro as a pure play, or you just want to watch it, watch that E7. That's the chart I gave you this morning pre-market. There's your positive divergence on the 60-minute chart. Positive divergence, divergent low, little minor trend line right there. Minor, it's not super important, but in minor resistance levels. That's why I said in that post this morning, this is the minimum target. That would be a back test of those recent lows I just showed you. 1, 2, 3, 4, a lot of reactions there. And it's a trade in itself. This is a forex, this is currency. It's 2%, doesn't sound like much, but it's all, you beta adjust your position sizes. I do that. In other words, the euro isn't going to drop 5-10% in a day. It's a currency. It doesn't move that much. So whereas you might normally, maybe let's say your number is you put $50,000 in Apple or QQQ as your number, you could put in 200,000-300,000 in this and take the same amount of risk because it moves less. So therefore, that what seems like a little minuscule 2% gain would put a same amount of profit in your pocket if the trade pans out. That's what I refer to as beta adjusted position sizing. And then finally, I like to do this from time to time. I know there's always new people coming on board and everything else. Let's just talk gold and the US dollar. So one way to do it, we can go like this. Edit chart properties, we can compare. We can look at, let's just do USDLR. DOLR, there it is. Here's a dollar index, but that doesn't go back enough. There's not enough history on this charting platform to do that. So we'll use UUP, that's the dollar ETF, and I'm going to turn that one off. See, and so the dollar and gold are inversely correlated. And some people, if you're not very visual, this chart might not be very clear. So all you have to do here, and what I had done, is turn it upside down. UDN is the inverse of the US dollar. And so remember, because when the dollar goes up, gold goes down. They have an inverse correlation. So when I flip the dollar upside down, it's showing that as a positive correlation, so you can see. Now again, if you're not used to doing this, let me just walk you through this. Do not pay attention or look at the differential in price because the dollar and gold are priced completely different and they move different in percentage terms. Currencies move less than commodities or metal. So let me just change this to an arrow tool and show you. What you want to look for is when the dollar is going down, which means UDN up, is gold going up? Yeah, and they peaked at the same time. They both peaked and then they both started going down. They both bottomed right here and they both started going up, right? They both had a major top here and they both started going down. So you can see every one. Look at all these little inflection points. And so if, and there are, I've always said this, just with about any securities, there are times where very well documented correlations can disconnect. And it's unusual, and that happened right here. So the UDN was going down, meaning the dollar was rallying, yet gold was as well. And that's very bullish. And I talked about it at the time. I said, when I see the dollar rising, yet gold going up, that's uber bullish for gold for me, because it means that the effects of a decline or a rising dollar, which are usually bearish for gold, are being offset by overwhelming demand or buying pressure for gold. And that was the beginning of that trend, and you could see gold carried up very strong. And then finally the dollar started correcting, but there it peaked and the relationship returned. So again, that's why. So there are those periods of brief disconnect. It can go the other way, but it's unmistakable. And I urge you to do this yourself. Go back 20, 30, 40 years, whatever you want, and you will see virtually unmistakable inverse correlation between gold and the US dollar. And now, last but not least, why do I use the euro? Well, it's just one thing I do, but we'll go here and you can see FXE. You can see mirrors that UDN, the inverse dollar index. So FXE, because the euro is the largest component of the dollar index by far, nearly 2/3 of the dollar index. That's why it is virtually a mirror or an inverse of the dollar, and also the euro then is positively correlated to gold. So to be bullish the euro is to be bullish gold. And then to be bullish gold is to be bullish GDX, the gold mining stock. So that's it, guys. I think I made a pretty decent case, but it's not an all-in case because the euro has just broken major long-term support. To me, it's a scale in. I mean, I threw the GDX out there a few weeks ago. We're down, but I'll continue to hold and add to those positions. And I showed you platinum and palladium running now too. They're precious metals. A lot of these companies, you can go to GDX. Remember, GDX is the gold miners ETF. But a lot of those companies, they're not just gonna, look down the ground, see a big slab of silver sitting next to gold and ignore it. No, they're going in, and there's places, and some of the companies have silver mining operations, certain mines that tend to produce silver. But a lot of these companies will produce gold, silver, and or other precious metals. And you can also target the silver miners directly from SIL, and obviously that also has a very similar setup. Again, there's a lot of overlap in these companies, but you tend to see what tends to happen is the silver miners tend to run harder. They're even higher beta, if you will, and they tend to move more and fall more than GDX. So if this trade pans out, or you want to diversify, you could take a little bit of SIL as well. And at this point in time, probably focus on the senior miners, GDX and SIL, but you can also, especially if we get going here later in the rally, or if you want to include a little now, the junior miners, they're just smaller companies, so they tend to move up and down more in percentage terms. That's GDXJ and SILJ. So, those 4 ETFs alone give you a pretty broad coverage of gold and silver mining stocks. Okay, we'll wrap it up here, and I'll continue to post updates on the sector, bullish or bearish, no matter what happens. And for now, really just let's keep an eye on the euro and the U.S. dollar, because that will we see that false breakdown. That's something we're watching that I can tell you a lot of other people just don't watch. And these miners are probably, a lot of people have been puking them up lately, meaning just throwing away the towel, giving up on them. And that's often when you see a nice bottom put in. So we'll see. And again, like any other trade, don't fall in love, don't get married to it. Again, at this point in time, I like it, but it's not an all-in moment until and unless I see that the euro recover those recent lows and make put that whole bear trap scenario into play. All right, we'll wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great day.